If your property registry in the booming Mohali real estate market is currently stuck in limbo, you need to pay very close attention right now. The Greater Mohali Area Development Authority, or GMADA, just pulled off a massive financial maneuver. They borrowed 2,500 crore rupees from other regional Punjab development authorities. GMADA holds property inventory valued at 24,000 crores, but their liquid cash reserves are practically empty. Heavily in debt, land compensations froze and infrastructure halted. To get bulldozers moving, they borrowed from other cities to pay bills. This government-forced liquidity creates a critical loan's terms. GMADA has a strict 3-year window to spend the money, finish projects, and repay the debt with 7% interest. They must aggressively push infrastructure to completion by early 2026 to auction surrounding land and pay lenders. Payouts enables the development of the largest structured, RERA-backed urban expansion in all of North India. But the plan on paper conflicts with the reality on the ground. The acquisition process is facing severe farmer protests and intense disputes over the Land Acquisition Act. There is an ongoing, high-profile litigation regarding guava orchard compensations that is currently keeping the entire development of Block A completely frozen. While Zone 2 offers the highest volume of available inventory, early investors face serious liquidity risks if ongoing litigation pauses the development of their specific block. Finally, we have Zone 3, IT City, covering sectors 87 and 103, along with Eco City 2. After a 13-year delay, crucial infrastructure tenders for zero liquid discharge sewage treatment plants and internal roads are finally moving forward. These facilities provide the industrial-scale utilities required for major commercial campuses, moving Mohali toward a Tier 1 IT hub status. This chart shows the institutional demand in hard numbers. During a recent auction, IT industrial plots in Sector 101 achieved a staggering 196% premium over their base reserve price. The trade-off here is the cost of entry. Getting a foothold in this zone requires massive upfront capital, a number heavily compounded by the newly hiked collector rates. Zone 3 is exclusively a heavy-hitting institutional play. It is highly lucrative for major investors, but almost completely out of reach for the budget-conscious homebuyer. So where does this leave you? The correct strategy entirely depends on your pocket size and risk tolerance. Let's map this out. If you are an NRI or a high-net-worth investor, your safest targets are IT City and Aero City Phase 2. The recent 2,500 crore loan guarantees GMADA will finish the surrounding infrastructure. Plus, the RERA backing ensures your capital is protected from the kind of private builder fraud that plagues other markets. If you identify as a speculator looking for a quick flip, you need to proceed with extreme caution. The 67% collector rate hike translates to massive stamp duty costs. That effectively closes the window for a quick 6-month turnaround. You have to be prepared to hold the property for at least 24 months to see real returns. And if you are a salaried end user just looking for a place to live, you should direct your attention towards the Zirakpok PR7 bypass or the Karar regions. Navigating the 2026 deadline isn't about hunting for a single best project. It is strictly about matching your specific financial profile to the correct micromarket risk. Chasing a government-forced real estate boom always comes with hidden costs. You have to account for the increased taxes and the potential for delayed possession dates. It comes down to a binary choice. You are either paying a high premium upfront for finished, risk-free infrastructure, or you are taking on massive litigation risk in exchange for cheaper, undeveloped land. The March 2026 infrastructure completion dates act as a hard deadline. Once those roads open, the market will permanently reprice itself based on the new connectivity. In real estate, having the capital is important, but getting the timing right is everything. The 2,500 crore injection rewards investors who identify their specific micro-market risk and time their entry accordingly.